This week is very important, possibly the most important week of the entire year. I have all the details and what you need to know right here in the video, so let's get right into it. All right, now in this video, I do want to talk about a few different reasons why this week is so incredibly important. I also want to talk about what we can anticipate to happen and what we can anticipate to be announced. Also, later on in this video, I will be talking about the stock market, but I'm going to wait on that until the very end because I do know that there are a lot of you right here in the community who simply do not care about the stock market. That's why I'm going to wait on that one until the very end of this video. But let's jump into it and talk about why this week is so incredibly important and what's going on and what we need to pay attention to. It all comes down to Thursday. Thursday is going to be the day that we're going to be getting the next inflation reading represented by the CPI, otherwise known as Consumer Price Index. This is a very highly anticipated number. This is something that everybody is watching right now because we are all recognizing what is going on with inflation. It's through the roof and it is not slowing down anytime soon. Prices continue to rise on literally everything, and this is possibly the most important report that is coming out as of recently. In fact, over the last year or so, this is possibly the most important report that we've been seeing on the economic basis. So let's talk about what this report means and what these numbers are actually going to indicate going forward as well. There's a few different reasons why this report is very important. Number one, this report that's going to be released on Thursday morning is going to give us a glimpse into the inflation for the month of September. Let me ask you this much. Did you see prices come down in your local area? No. The answer is no. Inflation continued to go higher in the month of September. Prices simply did not go down in the month of September. Therefore, we're likely going to be seeing this inflation number to be very high yet again, probably somewhere around the mid 8% range. So that's still very, very high, which by the way, the benchmark for the Federal Reserve is 2 to 2.5%. So we're like 6% above where the Federal Reserve wants inflation to really be. That is very problematic. Now, here's the thing. The Federal Reserve is going to be meeting again in early November to determine what they're going to be doing with their interest rate policy. Every 6 weeks, they meet for an FOMC meeting where a bunch of economists come together for a day and a half and they have a meeting and then they come up with an announcement to determine what they're going to be doing with interest rates, whether they're going to be raising them, lowering them, or keeping them the same. Well, if this inflation report comes out very, very hot again, as in basically anything. I mean, let's be very real right now. If this inflation report comes in very hot, like we're anticipating it to be, over 8% yet again, it's very highly likely the Federal Reserve is going to raise interest rates by another 75 basis points with their next meeting in just a few weeks in early November. That is, again, very problematic. That is not a good thing. Again, the Federal Reserve has the economy right now in the crushers, and the more that this inflation goes on, the more that the Federal Reserve is going to tighten up and crush this economy even more. So that's reason number one that we want to pay attention to. Number two, this is going to conclude the three pieces of the puzzle that we need for fixed income beneficiaries who receive Social Security, retirement, SSDI, survivors, SSI, VA, and RRB benefits to determine how much the annual cost of living adjustment is going to be. Now, obviously, I've talked about this a few times before in previous videos. I don't need to go into a ton of detail about this, but the cost of living adjustment is pegged off of the third quarter, July, August, and September inflation, the CPIW. So generally the CPIW actually does run a little bit hotter than the headline number of the CPI. So in July, the CPIW was 9.1%. In August, the CPIW was 8.7%. In September, it's probably going to be around, yet again, the 8.7%. And these numbers are going to indicate how much the cost of living adjustment is going to be for Social Security beneficiaries. Again, a very, very important number because the higher that percentage is, that just means a higher raise that you're going to get to your monthly benefit forever, starting in January 2023. So again, very important because that directly translates into how much of a raise you're going to get. It's like you're sitting down with the boss man at the end of the year, right? And they're giving you your annual review and they say, we're going to give you a blank percent raise. Well, we don't know what that's going to be as of right now, but basically the Social Security Administration is the big old boss, the head honcho, the guy on the other side of the desk, and you're having the review, and they're going to give us our raise here in just a matter of a couple days. So we will find out what that raise is going to be. Let's cross our fingers. It's better than a pathetic 2% raise like a lot of people are getting, and that's what usually people get with their annual review at a regular job. So here's the thing. An 8% raise, 8.7, 8.5, whatever it happens to be coming in at, it's likely going to be very, very high. And again, this is going to be a pretty nice raise for a lot of people. But again, I will keep you posted on that as we do get that information. So these are the announcements that we're waiting for this week. Okay, so this can be very important. Now, here's the thing. We might be looking at this inflation report and thinking, okay, it's just giving us a glimpse into the inflation for the month of September, and it's lagging information and all this stuff like this. True, but here's the thing. If this inflation report comes out very hot, the Federal Reserve is going to crush this economy even more. Now, here's the thing. I've said this before, and I want to say it one more time. If you are in the camp of wanting another stimulus check, the likelihood of another check being distributed is greater and greater the more that the Federal Reserve crushes this economy. So if you want another check, you probably want to cross your fingers that this is going to be a high inflation number, because that just means the Federal Reserve is going to be more aggressive, crushing the economy. And when this economy crashes and burns, falls out of the sky like a big old fireball, then again, there's likely going to be more checks on the horizon. Just saying. But again, we will cross that bridge when we get there. All right, so that's what I wanted to point out to you. This is very important. It's more than just a headline number on inflation. This is basically the dog wagging the tail of the economy. And basically, it's going to indicate to the Federal Reserve what they're going to do with their next meeting. Which, by the way, a few days ago, on Friday of this past week, we got the jobs report. The jobs report came in very strong. Another 263,000 jobs were created, and the unemployment rate fell down to 3.5%. Generally, that would be a good thing. It's not a good thing in this case because it's showing that the economy is still overheated. It's not good, okay? They want to see the opposite happening. They want to see less jobs being created and the unemployment rate rising. That's what they want to see right now. It's not happening. Therefore, the economy needs to get crushed. You know what I mean? That's just what they're doing right now. And again, this is not me that wants this to happen. I'm just simply telling you, this is what's going on because this economy is overheated, and as a result of it, the inflation is way too high right now, too much money floating around, and as a result of that, we are seeing increased prices on literally everything right now, and it's really hurting a lot of people in a really big way. So anyway, they got to get this inflation kind of controlled, and they got to get this thing handled. All right, now let's quickly talk about the stock market. So a couple days ago, I was out in a separate video, and I was talking about the major plunge in the stock market. Here's what's going on here. Okay, so I've been watching the markets for a very long time. In fact, I've been watching the markets for about 14 years, literally every single day. I am very much involved in the markets. I watch everything closely. I watch the stock market, bond market, precious metals, commodities. I watch real estate. I watch crypto. I watch all of it very closely because I understand it's like a big old engine. If a gear strips out, if a belt breaks, if a chain breaks, something like that, it's going to take down the whole thing, okay? It's all intertwined very closely. So here's the thing. I've been watching the markets for a very long time. I'm seeing a pattern playing out in the markets right now that is indicating a major plunge in this market coming soon. Realistically, I don't know exactly when. I cannot pinpoint an exact day as of right now, but all I can say is soon. Possibly this week, possibly next week, sometime within, I would say, a relatively short amount of time, there's going to be a major plunge according to what I am looking at. Now, to be totally real, I could be 100% wrong. We could see the markets go up 10% this week. I mean, seriously, anything could happen. I could be 100% wrong with all of this. That's what makes a market. That is exactly what makes a market. There's one person that said the market's going up. There's one person that says the market's going down. One person is buying, one person is selling. That's exactly what makes a market, right? Buyers and sellers coming together, exchanging shares and cash and money, stuff like that. Same old thing, okay? So I just want to make it very clear. This is not trading advice. This is not investment advice. This is not advice in any way, shape, or form. I'm simply saying this is what I am looking at right now. I'm looking at this market. Here's the thing. The stock market and any market out there, we could be talking about the real estate market. We could be talking about the market on candy bars. We could be talking about the car market. We could be talking about bubble gum. We could be talking about gallons of milk. We could be talking about eggs, bananas, apples, meat at your local meat counter. It doesn't matter. You could be talking about anything. Lumber. Doesn't matter. Anything that's for sale. It all predicates on supply and demand, okay? Willing buyers and willing sellers. When you have more demand, as in more buyers, prices must go up. When you have more sellers or more supply, prices must go down. Simple economics, supply and demand. Here's what's happening. The market trades on supply and demand just like everything else does. As we're continuing to watch this market right now, prices continue to go higher and then they go lower. As prices are going lower, they continue to bang against this lower end of the range. This lower end of the range is basically eating up all the demand in that area, okay? So imagine like, what's a good analogy? I don't really know a good analogy. I can't think of something off the top of my head. But essentially think of it this way. Every time the price comes down and continues to revisit this same area that price has been before, not a good thing. Some people out there say, oh, the more times that price visits an area, the better. No, it's not. It's a bad thing. It's eating up the demand in that area. In other words, willing buyers. So the price continues to come down and retest all these areas over and over and over. That is not a good sign. It is building a descending triangle. So if you look at technicals and you look at the stock market and you know what a descending triangle is, it's literally a triangle that has a descending pattern. The angle on the triangle is descending. Therefore, the bottom is going to fall out of this thing and we're going to see a massive plunge. Now, there's also something called a measured move in the market, okay? So generally what the measured move is, you take the high of the triangle and basically you measure it down. So basically what I'm looking at right now is a plunge in this market anywhere between about 15 and 18%. Again, it could be 5%, it could be 7, it could be 20, it could be 25, or it could be right in line with what I'm looking at. But I'm looking at a plunge in this market very fast, a very swift move lower of about 15 to 18%. So that's just what I'm looking at right now. Again, I could be 100% completely wrong. Now, here's another thing too. I want to point this out as well because this does happen so often. In patterns like this, a descending triangle, an ascending triangle, symmetrical triangles, double tops, double bottoms, all stuff, things like this, these different patterns. Here's what happens. Sometimes there's something called a bear trap or a bull trap. Here's what happens. In this case that I'm talking about, a descending triangle, price breaks down from the lower level of the descending triangle. It starts to collapse, and then sure enough, it reverses and rips the opposite direction. What happened? It's called a bear trap. Basically what happens is a lot of people are looking at the lower end of the descending triangle. When it breaks down, people start exiting their positions, they have their stop losses below the level, and of course they start shorting positions. Well then institutions and big banks and the people with the big money, billions of dollars step in and trap all of those bears and rip the market higher. It's called a bear trap. Same thing happens on the upside, which is called a bull trap. But in this case, we're talking about a bear trap. So again, that could be said as well. We could be looking at a big old bear trap. Don't get your foot caught, right? Ouch. Don't get your foot caught in this one. But my point is, I'm looking at this right now. I honestly do not think there's a bear trap. Here's why. This market is trending lower. In a lower trending market, generally you don't get bear traps. If you have a market that's trending higher and all of a sudden the market breaks down, that's when you see bear traps, okay? It's usually in an uptrend and the market breaks down, that's when the bear trap is set. Usually in a downtrending market, you do not see a bear trap. You would most likely see a bull trap, which is likely what we've seen over the last couple weeks here as price continued to rally higher and move higher, trapping all those bulls that were buying into the rally. Again, hope you're not one of those people. So again, I've been talking about this for a very long time now. This market is setting up for a big plunge. And again, I just want to make it very clear. This is not advice at all. To be completely transparent with you, the last week and a half or so, I've been building a short position in the market, which means I'm betting that the market will go down. So that's just something I am in right now. I'm short the Russell 2000. To be completely transparent with you, that is my favorite one to trade and invest, or more like short is what I should say. So in this position right now, yes, I am short the Russell 2000. And again, I like to be completely transparent in my videos just to let you know over the last week and a half or so, as the market was going up, I was shorting into all that strength. And again, the last couple of days here, the last couple of trading days, we saw some major moves lower. So again, pretty nice if you're short, right? Anyway, the other day I was out in that video and I said I was going to come back and talk about this in one of my dedicated videos. I wanted to break this down for you. But again, what I'm looking at here is in the event that this triangle pattern and the bottom falls out of this market, because we've been hitting on these lows over and over again, eating up all the demand in this market. In other words, the buyers at the levels where prices continue to bang against are disappearing. The buyers are getting exhausted. Therefore, the supply and the sellers are coming in. They're going to exhaust all the buyers, and this market is going to get a huge rug pull on it. That's what I'm seeing happen, and we're likely going to get a measured move of about 15 to 18% lower. That's just my estimation. Again, when I throw it out there, I've said it a few times now, I could be completely wrong. We could see the market go down 2% and rip higher. We could see the market go down 5%. We could see it go down 10. We could see it go down 20 or more. Just saying. This is what I'm seeing right now. I'll come back to this video at some point here in the future. I wanted to put this out there for you, let you know what I'm watching. I know that a lot of you here in the community probably don't care about this stuff, but when I see major signs like this happening, I gotta bring this to your attention, because if you're somebody that watches this stuff closely, or if you're invested, or if you know, whatever you're doing, I just want to bring this to your attention. Any major issues like this, I need to bring to your attention. One more thing, last little quick side note, and then I'm gonna let you go, which is this. When we see the markets collapse like what I'm anticipating here, this generally is not a good sign for the economy and all kinds of things like that. The stock market leads the economy. You've probably heard that before. If you see the stock market collapse, generally the economy is not too far behind. When you see the stock market bottom and go higher, generally the economy is likely not too far behind, okay? So just want to throw that out there. So when we see the stock market go down in a big way, it's likely going to bring the economy right along with it. And again, if you're in the camp of somebody wanting more stimulus checks or direct payments or something like that, when we see this economy collapse and fall into a deep recession, which is what people are anticipating right now, again, the likelihood of checks goes way higher. I've talked about it before. The last 3 recessions that we've seen have all produced stimulus checks. So if you want more checks right now, you should be crossing your fingers that we fall into a recession. I mean, seriously, that's kind of what you should be hoping for. If you want more checks to be going out, you should be hoping for a recession. So again, just want to throw it out there, and which, by the way, a recession would bring down this inflation somewhat, because a lot of people would be contracting at that point. And again, this is just what's happening out there right now. I'd like to keep you updated with what's really going on, because is your local news talking about this? I mean, tell me this much. When was the last time your local news station talked about a descending triangle in the stock market and a major plunge and rug pull? I mean, seriously, they probably never said those words. They probably don't even know what a descending triangle is. Let's just be real right now, okay? Just being real with you, okay? So anyway, I hope this video helps you out. I will come back and revisit this video in, I don't know, a few days, couple weeks. I'm going to continue watching everything closely and let you know what's going on here. And of course, I will keep you updated with everything going on this week. It's a very important week. Watch on Thursday. And again, all the announcements leading up to that, I'll be right here for you, right by your side every single day with everything going on here. I'm here for you in any way that I possibly can be. Please subscribe down below if you haven't done so yet. Share the video with your friends, family, social media, and go back and check out any of the other thousands of videos here on the channel. Until next time, enjoy your day. Have a good one, and I'll catch you again.